through what's been happening in the Irish real estate market in recent years. Probably just a little bit of background. I don't think I need to tell you that Ireland suffered a little bit more than most in the financial crisis, and our banks had probably behaved a little bit irresponsibly, to put it mildly, back between 2000 and 2007 perhaps. And as a result, the banks suffered worse than a lot of other banks, and our property market collapsed, values plummeted. Essentially there was stagnation in the real estate market, nothing was being sold, no one was buying, and it really wasn't a good time to be a real estate market. So what happened next? Probably the most significant development in Ireland in the real estate market was in 2009 the government formed the National Asset Management Agency, and essentially this was set up to acquire the property loans of our bad banks. They acquired the loans of 6 banks: AIB, Bank of Ireland, Irish Bank, Irish Nationwide, Irish Bank Permanent, and UBS. And throughout 2009 or 2010 and early 2011, we were going through this tortuous period of legal and property due diligence, which did create some work for property lawyers, but not the kind of work you want to be doing. Your own transactions and trying to get paid by NAMA, as we call it, not always that easy. So following this due diligence period, the loans transferred from the banks to NAMA at what they called a haircut, and they acquired approximately 70 to 75 billion of debt at 42% of the nominal value. And at the same time, we had what we call the non-NAMA banks that were active in the property market in Ireland. We had Lloyds through the Bank of Scotland and Rambo through an Irish subsidiary, ACC. They all decided that Ireland was not the place to be, trying to get out of debt, and they just started to exit the Irish market. They started appointing receivers. They weren't very patient with their borrowers. They just said, put in the receiver, get the place ready to sell, and let's get out of here. So the road to recovery, times were difficult up to 2011, 2012. 2012, we started to see some green shoots, and in this graph here just shows the Irish investment market turnover. And we see here we have the peak of our property boom, and then collapse, and then in 2012 things started moving again. In 2013 they were close on 2 billion turnover in property transactions. Major growth in 2014, and you see 2014 there, the turnover in the Irish investment market even far exceeded the peak of our boom back around 2006-2007. So we saw in 2014 we had 4.5 billion in property transactions, and this is continuing. Now, the NAMA sales are a major driver. NAMA decided around 2012 it was time to start going back into the market and disposing of this huge property portfolio that they were holding. They told us that by August of 2014 they had made 16.6 billion in asset disposals. Now, as well as in the Irish property market, they also held a lot of assets in the UK, across continental Europe, and in North America as well, because Irish investors weren't very discriminatory as to where they invested. They bought stuff everywhere. So, and the Irish banks lent on assets all over the place. So as of 2014, they sold off 16.6 billion. Now, the original intention with NAMA, the government had set it up and said, look, we're going to give 9-10 years to just get rid of everything and finish up. That's been accelerated a little bit. We've got an election coming up next year, and the government are saying we'd like to be able to tell people before the election that we've made all this money back for you. So they're putting political pressure on NAMA to accelerate their whole disposal process, and that's starting to happen. So they're starting to put stuff on the market a little bit quicker than was originally intended. Now, the features of the property transactions in Ireland at the moment, what we're seeing is a lot of portfolio sales. And both NAMA and the non-NAMA banks are tending to just group the assets, put a group of assets together and sell it as a portfolio. The purchaser has to take all or nothing. As a result, we're seeing large transaction sizes. These are the top 10 transactions in 2014, so they range from 375 million to 135 million. This one, the Acorn portfolio, there we were 171.5 million. We acted for the vendors and that on the instructions of NAMA, and that would be typical of the type of portfolios they're putting together. You tend to have one or two of the assets, maybe 5 or 6 assets included in the portfolio. 1 or 2 will be the jewels in the crown. You'll have 1 or 2 will be just okay, and then you'll have the runt of the litter. You'll have something that the only way to get rid of it is put it in with something that is actually attractive to the purchaser. So in that one, the Acorn portfolio, we had a shopping centre in Cork, a retail park in Cork, we had a Dublin shopping centre, and then we had a small shopping centre somewhere out in the provinces that nobody would have bought except that it was full of the better stuff. And so far the concentration in them, you see there, most of them are certain mixed-use portfolios or retail, but now we're starting to see a bit more movement in residential and also particularly in the office sector. Geographical location of activity, unfortunately, well, fortunately, depending on where you're based, but similar to the UK, I think in other countries, we're seeing a lot of concentration around Dublin and around the capital. In 2014, 79% of the volume was Dublin-based, but we're seeing activity now in Cork and Galway, particularly in larger assets. There is quite a lot of activity in that area, but the recovery throughout the rest of the country has been quite slow. In rural areas in Ireland, and NAM is holding a lot of development land, which is zoned for residential purposes. But I think, for the foreseeable future, or maybe forever, the only residents there will be sheep and cows. The investor type. We're seeing a lot of the private equity money coming in. It's all the usual players, Kennedy Wilson, Blackstone, Bard, Partners, Hines. And they accounted for 34% of 2014 investment volume. REITs as well are starting to become active. About 2 years ago, one of the steps that the government did take was to introduce legislation which allows the incorporation of REITs in Ireland. And so far there have just been 3 Irish REITs have listed, but they've been quite active and are getting more active than 23% of 2014 volume, and in the institutional investors with 13%. So where are we going from here? There's a positive economic outlook in Ireland, which is bearing fruit in the whole real estate sector, certainly our residential market, which was completely stagnant for 4 or 5 years, is starting to happen again. Prices are going up. The office market is also particularly strong. We're seeing a lot of foreign direct investment into Ireland, and they're looking for high quality office space. Our only problem is that we have a lack of supply in that area outside of Dublin. There's good quality office space available in Dublin. So Dublin is continuing to be the main focus. We're facing challenges. As I said, the lack of supply outside Dublin is a bit of an issue, particularly in the office market. Development finance is a problem as well, because obviously we need to build to cope with what hopefully will be a higher demand, but our banks are slowly getting back to lending, but people in development are finding it hard to get finance, and that's something that's a problem. Retail sector growth is needed. Our retail sector has suffered a lot. Irish people are still averse to spending because of what they've been through over the last 10 years or the last 8 years or so, but it's starting to improve, and hopefully that's going to benefit the retail area. Excessive regulation. The government have taken some steps to try and boost the property market. The introduction of the REITs, they reduced the stamp duty on commercial property to 2%. But there are some legal issues. One area that's caused a bit of uncertainty in the market has been the whole area of rent reviews on commercial leases. Like in the UK, our commercial leases have tended to be traditionally 25-year leases with 5-year rent reviews. Now, as in the UK, the rent reviews were invariably upward only. But the government came under a lot of pressure, particularly from the retail lobby, to legislate against upward only rent review, and they eventually caved into that. And in 2011, I think it was, they effectively banned upward only rent reviews on any leases created after that date. So now that we've got a two-tier situation with commercial leases, you've got some which have rent reviews that are upward only, and you've got some which are the reviews to over market rent. And so it's just for investors it creates a bit of difficulty, because you go to buy a shopping centre and you put it with a certain rent roll. You have to look through each of the leases and say, well, is this upward only or is it open market? And therefore, how many of these leases are likely to see a rent drop in 2 years' time, 3 years' time, whatever? So that probably has created a certain amount of uncertainty. And there was some pressure on the government to try and bring that in retrospectively, so that effectively what was an upward only rent review lease would suddenly become a review open market. And because the government were making signals that they thought they might even do that, it created a lot of disquiet in the market, but I think everybody accepts that that's not going to happen. On the construction side, one of the features of our property and construction boom 10 years ago was that we had a lot of amateur developers, and unfortunately that meant that some of what was built, particularly in the residential area, was not of the best quality. So as a reaction against that, the government and the planning authorities have introduced a lot of stricter regulation around construction and also around the planning guidelines and so on. But it's felt in some sectors, certainly a lot of the architects believe that they've gone too far, and that they've made it more expensive to actually build stuff now than would have been the case previously. And that is a little bit of a restriction on development going forward. So the future, one thing that we are seeing at the moment is because of the acceleration of the NAMA process particularly, is that rather than asset sales, they've decided that they're doing more loan sales, so we're seeing that is happening a little bit. The other thing is, I said, the early birds are taking flight. Some of the big players that came into the market back in 2012, 2013 are now actually starting to say, right, it's time to move on and let's cash in our chips here. So they're going to start selling over the next period of years. And hopefully that means that there's going to be a vibrant activity in the market over the next few years, and maybe on this occasion we'll have more Irish-based investors who will be in a position to participate in that, and it'll lead to a more stable and predictable market in the future. I was just along with Mr. Herzog and Mr. Schellenberg and a few other people. I participated in the half marathon yesterday, and it occurred to me this morning that it was a little bit like the experience of the Irish property market in the last 10 years. It was a long, hard road. There was a lot of pain along the way. Still feeling a small bit of the pain. But having got to the other side of it, I think we're a little bit slimmer, a little bit fitter, a little bit healthier, and certainly a little bit wiser. So thank you for your time.